to...
Welcome back, friends. I want to show you a few little tricks that you can do with your indicators. On the screen here, you can see that we put the Bollinger Bands up a moment ago and the stochastic oscillator. I'm going to give you a brief description of each of these, and then we're going to play around with them a little bit. The Bollinger Bands take the recent price action and then show you what the standard deviations away from that price action are. In other words, for example, price has been moving in a tight band across these candles right here. And the Bollinger Bands say all price, most price, 61% of price or more, should fall within these bands right here. These are two standard deviations outside of price. The middle band is simply the average of price over a subset of bars or candles. Bollinger Bands form an envelope around price and show you the maximum distance that price should be moving. And generally speaking, people believe that when the price hits the upper Bollinger Band, it's done something quite exceptional. Okay, that's a general overview of Bollinger Bands. The stochastic oscillator generally is seen or viewed to show when the market has moved up too far, too fast, over a short number of candles. Over the course of the last 14 bars or candles on this chart, if it moves up really far and really fast, the stochastic will go into overbought territory, suggesting that price, compared with its recent performance, has moved up too far, too fast, and then that's called overbought. Indicators and oscillators get a bad rap, and the reason they do is because sometimes it's not that hard for them to go into extreme territory. You can see the stochastic bouncing up and down amongst overbought and oversold, and you can really start to wonder, is that really valid? If it's always doing it, how valid is it? Well, I want to show you a little trick that I like to do with indicators in this lesson. First, we're going to click on the Charts window and Indicators list. And that should pop up a little box that shows us the indicators that we have on our charts. Bollinger Bands is the first one. I'm going to highlight it and then click Edit. Now we're going to do something that most people will never teach you to do. The typical period for a Bollinger Bands will be 20. Now, I don't know if that's the best period, but that's the typical period. You might see in your charting platform 21, or read in a book that it's 21 or 20 or some other number. Most people will never change that number. They'll just do whatever the program tells them to do. Let's do something crazy. Let's multiply that number by, I don't know, 10. Or let's change that from a 20 to a 400 and multiply it by 20. Or some crazy thing. The next number that's kind of interesting is the deviations. Deviations it's all about statistics. It'll show you two standard deviations outside of normal price. The higher this number, the wider the bands will get. So let's change that to 5. When we do that, all of the sudden, the Bollinger Bands seemingly disappear. Well, they're still there. It's just a much, much, much wider envelope across price. And it's way more difficult for price ever to reach either extreme. In other words, if price ever does reach one of those extremes, it might be more meaningful. It might actually mean something more significant if price ever actually reaches it. Now, in this example, price never even gets there. We may have placed a somewhat massively extreme level on our Bollinger Bands. So we'll go to Charts, Indicators list, Bollinger Bands, and we'll change our standard deviations back down to 2. What that will do is it will tighten the bands up a bit, and now we have these weird things that we didn't see before. We can now see examples where price actually goes outside the Bollinger Bands. Now this is interesting. And it uses the Bollinger Bands as kind of a level of support if it travels back to it. And we could see that sometimes when price drops outside of the Bollinger Bands, it's going to need to snap back inside those bands. And it doesn't happen very often anymore. Trading systems aren't built from something that happens all the time. Otherwise, it's not really something you can use. It has to be built from something that doesn't happen very often so that you can distinguish it from all the other ordinary price movement. Now let's do something similar to the stochastic oscillator. I call what we're doing slowing down the indicators. We'll click on Charts, Indicators List, Stochastic Oscillator, and Edit. We'll choose Parameters. And remember what we did before, Nate? We changed the numbers. Give me a number that we might change the stochastic to.
32.
32. Let's change the slowing number down to 9. Let's change the D period to 9. If you're wondering what those terms mean, it's all part of that complicated math that goes into creating this indicator in the first place. We'll click on Close. And all of a sudden, our bouncy oscillator that was all over the place has slowed down, has become much smoother, and less frequently goes into overbought and oversold territory. What we're doing here is we're slowing down the oscillator and the indicators, suggesting that there might be a way for us to create a trading system. For example, with this combination, we might look at places where price goes down to the lower Bollinger Band, but then is oversold. Over here, it didn't reach down to the bottom of the Bollinger Band, but it was oversold. Well, we just ignored that. But here we have both conditions. That's a trading system. We wait for certain conditions to exist in our indicators, and then we make a standard, ordinary, rule-based trading decision from those suggestions. What we've just done here is we've played with the numbers behind the indicators. And what you could do now as your homework or as an assignment is you can pull up any number of indicators on your charts. Any of these, the average true range, the trend indicators, the Ichimoku Heineken cloud, the commodity channel index, the MACD, and you can take the standard settings, which don't seem to be very useful to most people anymore. And what you can do is you can slow everything down, change the numbers around, and get a totally different looking situation, a much smoother view of what's happening with price on the charts. All right, that concludes our little tricks with indicators lesson. I want to thank our sponsor, Forest Park FX. If you're interested in trading FX, contact Forest Park to receive cashback rebates on every trade you place and open up a trading account. You can go to forestparkfx.com. Remember, Forex trading carries a significant risk of loss and is not suitable for everyone. Terms and conditions will apply. And we'll see you in the next lesson.